Hi everyone, and welcome back to the Aussie Expat Podcast. Very happy to have Jamie and Tristan with me again. Today we're going to spend some time to break down some common questions we get around repatriation. It's a big topic. We did mention in one of the other podcasts that we should spend some time on it, and I think it's something that every expat really needs to be thinking about probably a bit earlier than a lot do, because a lot of the questions we seem to get seem to be right before they go.
Yeah, it is. Yeah, including from at the airport. So
yes.
A few phone calls there, really.
So there's when you go back, and it really depends on how long you've been away, but you could have even only been away a year, you still need to be thinking about when you go home, where do I want to be? What kind of position do I want to be in? What are the things I need to be thinking about while I'm away to make sure that when I get back, I'm set up for the future? Because there's a lot of little traps, a lot of little things that can come up that you don't even think about, taxes especially, but also on the investment side too, like structures, pensions, superannuation. There's a whole lot of different rules compared to when you're away, compared to when you're back home.
Yeah.
So I think, the thing I want to really spend some time on first is tax, because that's the number one set of questions that I think we all get.
As you mentioned before, it's about putting the end at the start. So starting with like the end in mind of how do you start planning.
And I think when you guys are answering, just think about there's probably a few different periods people need to think about before they go back. There's the 12 to 18 months before you go, the 6 months before you go, and then that first 12 months when you get back. As well, which can be a shock to a lot of people, especially if you've been away for a while. Yes. We hear the reverse culture shock can be very real for some people.
Yeah, that's real. I had a client that said to me the other day on a call, there's like, why do people move to Australia? And they've been living there for, I think we had finished one tax return. So they sort of saw their, and I was like, it's lifestyle. And he's like, lifestyle's pretty good. He's like, the missus and the kids are pretty happy here. Yes. I said, we just need to manage the tax side of things. I was like, yep.
So maybe, Tristan, first question for you. Residency status. Is it just you pack up the day you land, you are a resident again, or is there a set of steps or a set of things that confirm when you become a resident?
I guess long story short is it's complicated. Yes. But like largely speaking, for most people, it'll be the day you arrive back in Australia with an intention to stay. You've got your shipping container on the way. You've got the dog packed up on the way over there too.
You're ticking that arrival card that says I am moving here permanently.
Correct. Yes. Yeah, and you've got an intention to stay, but there's. With a lot of families, it's not always that cut and dry. It's it's sort of sometimes you've got one of the spouses will stay back and remain in Singapore for a period of time to wrap up work, to stay out of Australia for a bonus that's coming through, which is quite common, or just basically they're not they just can't go back for work yet. So in those situations, it's very much the residency piece is, very much depends on, do you have a spouse and a house in Australia? So, that's a big common thing. I do a bit of work with one of Australia's best tax lawyers who's, great resource. And he always says to me, when you've got a spouse and a house in Australia, you've got to be really careful. Your day count drops to more like, 45 days, that sort of thing, which is not to be mistaken by the proposed residency rules that have been stuck in the mix for a couple of years now, basically.
I'll get you to comment on that in a minute, but I guess the message there is you say you've got a typical family unit, the husband is still working for maybe 3 months before he moves back, but the wife and the kids have gone before. Is it a case where the husband could be a tax resident if the wife and kids have moved before
quite possibly.
He finishes working?
Quite possibly.
Okay.
So there's, if we quickly talk about the three residency tests, there's resides test, the domicile test, and the 183-day test. So resides looks at resides in accordance with the Oxford Dictionary, so it's very vague. There's lots to consider, and it's very much where are you living, where's your family, where's your life, where's your stuff, where's your dog, where's your cat, all that sort of And then you've got domicile tests, which is one that catches people out without realising, which is me and Jamie had a client, we were talking about this the other day, where it basically says if you're an Australian citizen, you're domiciled in Australia for tax purposes, therefore you're a resident for tax purposes unless you have a home elsewhere. So that's really important in those situations where one of the two of a couple are staying back in Singapore, making sure you're maintaining a home. Home doesn't mean you have to own it, just means you're renting it and it's got all your stuff in it and it's where you're living. So you can maintain that home up until pretty much, very close to your exiting Singapore. There's always, a couple of days that you pack up the house and wrestle with the landlord about giving you back your bond and, stay in a hotel. I think Marina Bay Sands is the most popular final destination for most expats or the W. I think that's a good one. But and 183-day test is just looking at day count. That's more to catch you when you're spending too much time in Australia and the other tests don't catch you.
You touched on the proposed changes that we've heard a lot of noise about over the last couple of years. I guess, from your perspective, any updates, anything else you would want to say?
Nothing. Like it's sort of the, I've got my ear to the ground, of course, but, they've been stuck in Parliament for at least a couple of years now. When they do come in, it'll be a bright line test based on a day count and asset tests. So for most Australian citizens living offshore will be stuck in the lower day count because there's 4 tests. One is either basically owning property in Australia. Another one is having a substantial deposit in Australia. The other one's having a right to go to Australia anytime you want. You're a citizen. And then there's another having just a home available to you. So once you meet 2 of those tests, you're in the lower day count. The proposed rule said 45 days. That's where it got stuck. And, we're looking at more like probably 60 to 90 days. But main thing is they haven't come in. We're still boxing at shadows here. And when they do come in, they'll be effective from 1 July the following year. So no one needs to panic yet.
I will be very surprised if it stays at 45 days. For anyone that's, even think big Australian companies that have employees abroad and the amount of people that will get caught up because they have to just go back for work for that many days a year. It's just doesn't seem like a workable scenario for anyone to work under.
No, definitely, I think there could be the TIES test as well. So something similar to the UK, if you're pulled in for work, it's a different amount of days whereas you're pulled in for family or holidays and things like that as well. So personal versus business might be separated. That's exactly the sort of commentary that's bouncing around in the background, Jamie. So it's the and that's I think it was the tax. I think it was the border taxation just didn't foresee so many people objecting to this, and so much of an effect on Australian businesses having employees offshore.
And there's a lot.
There's a lot. Yes.
Income and capital gains tests, the difference between when you're offshore versus when you're onshore. I know it's a whole topic on its own, but maybe just break down some key points.
Okay, so capital gains. So for those based in Singapore and Hong Kong, there's no capital gains tax there, as we all know. Jamie does a great job setting up portfolios for people, or capital gains tax free. But as soon as you jump across the line and become a resident for tax purposes, all your assets follow you back into Australia. So that's the kind of the point. You either need to have a chat about tax structuring, or looking at and tax structuring might be putting them in a family trust, putting them in an offshore wrapper, putting them in super. Putting them in your spouse's name if they're not earning more from you. If you're on more than your spouse, simple restructuring there. And that's and then once you're in Australia, capital gains tax applies. And you've got things to think about, like the 50% capital gains tax discount and how that applies to the time that you've held the asset, whether you need to hold it for 12 months in Australia or not to qualify for it.
I think our next podcast will be a whole topic on restructures and things to be thinking about. I think the thing I always, the number one thing that I always tell people about investments is, and where most people get caught out, and this is both for property and for shares and other listed items, you need to make sure you take the values of those investments on the day you leave Australia, and you need to also take values for the day of those investments that you arrive back in Australia. Because they are the key points of when capital gains gets calculated when you're offshore or onshore. right? And most people don't realize
Yeah.
they should do that, or just write it down, or download their share statement on that day and just make sure they have a record of it.
Yeah, and the
Save you a lot
hardest
of
thing
pain
is
later.
exactly. And like the day you move back, you can't necessarily control the share price, right? So
Exactly.
if it's high, potentially a good position to be in.
Mhm.
If it's low, then that makes it quite difficult from Singapore to Australia transition.
100%.
It does, yeah. But basically coming back to Australia with a low share price means that when it eventually recovers, if you're a resident for tax purposes, you've got to pay tax on the recovery swing. So, that's where you might want to, think more about structures.
Yes.
For example, the offshore bonds, that I know Jamie helps a lot of his clients set up. If it's in there, it's tax-free for the first, or tax deferred for the first 10 years and tax-free after that. So if it does have that swing, you're less concerned about the tax impact,
Yes.
especially if it's for retirement savings.
Yeah. And it's also part of just getting advice before you go back.
Yes.
As well, I always put this. There's kind of two parts to this advice. There is the 12 to 18 months before to just make sure the investments are in a good structure. Can they be better? And then the 6 months before, you should be thinking about, do I want to sell anything before I go back? And this is also, both on the property and on the share side as well.
Yeah, exactly.
So,
change the asset classes.
exactly.
One question I get all the time, and it's a tricky one for people potentially in tech companies, is the exit tax out of Singapore.
yes.
I don't know, you're not a Singapore tax accountant, but maybe if we touch on that, because sometimes that does get people a little bit unstuck when they're exiting as well.
No, that's a big one actually. So Singapore's last bite of the cherry is to tax you on unvested shares when you leave Singapore. So at that point in time, it's not like you can sell them. So Singapore government says, you're leaving. You've incurred or basically enjoyed or been given $20,000 worth of shares that will vest at some point in the future. We're going to tax you on the market valuation of those shares at the time, which is $20,000, and you can pay tax on that on your exit. So you're basically paying tax on shares that you don't own at that particular point in time. Well, they're in your name, so it's more be prepared to pay tax on exit of Singapore, even though you may not. You may not have the cash because you haven't sold the shares, sort of thing.
Yeah.
So that's a big point. And then Australia obviously will tax you again when they eventually do vest, less the tax you paid in Singapore.
So you do get a tax credit for the funds that you paid here, right?
And more importantly, which does happen from time to time, you go back to Australia, you find a better job and say, see you later, Google, for example, and they say, well, you're not getting your shares, and you say, I've just paid all this tax on these shares as I left Singapore. You can write to IRAS, and they'll give you a refund of that tax that you paid on unvested shares that never vested.
Up to 5 years, I think.
Yeah, spot on.
The limit from that side. Yeah.
We've talked a lot about tax. The next thing I wanted to focus on was actually more around superannuation and some kind of basic retirement planning that people need to be thinking about when they're both away, and then once they go back, how they potentially change their investment strategy or how they can roll over pension assets that they've had when they were offshore. So I think, if we're talking about like Singapore or Hong Kong or the US, I'm not expecting you to give US tax advice, Jamie, so don't worry. But in a lot of these countries, especially if you've got permanent resident status, you might have CPF, you might have MPF. Is there a mechanism once you leave, say, Singapore or Hong Kong, to take your pension assets and roll that into your super when you return to Australia?
I think, just in broadly on the retirement planning side of things, like in Australia, superannuation is a fantastic vehicle to save for retirement. There's obviously tax incentives to do it. Employers also contribute that. When you're an expat, it's not guaranteed that you'll get any contributions to super, so it's up to yourself to do it for most of the part. If you're a permanent resident in most jurisdictions, say for instance Singapore, Hong Kong, you get CPF here, you get MPF in Hong Kong, 401k in the US and things like that as well. But those structures aren't necessarily recommended or not noticed by Australia to be able to transfer them straight from CPF or 401k straight back into super. So there are some different things that you have to do from a planning perspective, because they kind of do potentially get trapped offshore. So there is some things that you can do to get that money back. It does become a timing issue because you have to give up your PR, but you also might still be in the country for that period of time, which can be kind of problematic from that side. So from a CPF perspective, giving up your PR, essentially you have to do that the moment you leave, and then you can potentially get those benefits out. However, that can, if you're in Australia at that point in time, Tristan can help with this part, but it could become taxable, those benefits. So you have to try and do that while offshore, but you also need somewhere to live, so it becomes quite difficult, and there's a bit of planning around it from that side. But I think funding that retirement gap when you're away, whether it is through the PR permanent resident mechanisms like CPF and MPF, or you do it yourself personally, can be obviously a big thing, because if you're away for 10 years like we've all been, if you're not putting away that 12%, it does start to compound. And like we've got some calculations on like retirement funding gaps that start to eat into that quite significantly, because my poor superannuation hasn't had many contributions in the last 10 years.
I haven't had any
from that side. Exactly.
Taking it just depends. I think I mean, my next question to you was going to be, is it worth investing in super while you're away? But I think it depends. It depends.
It definitely depends. So if you're getting closer to 60, because the 60 is the mark where you can access it if you're retired in Australia, and it's tax free. So at that point in time, it makes a lot of sense. Or in the years leading up to that, if you're 40 to 50, then essentially there could be better tax effective vehicles offshore than there is in superannuation from that side of things. So it is a balance, and depending where people are in their lives, for instance. But anyone who's 60 or above, superannuation becomes extremely tax efficient from that side. The other part that people not talking about taxes don't necessarily talk about is the investment side of things. So the actual assets that you're investing within superannuation or through your own retirement scheme. There is the ASX 200, for instance, and that, for those who don't know, is the top 200 companies in Australia, and as an index. So you're essentially buying into the likes of Commonwealth Bank, PHP, Fortescue Metals, those kind of companies, and they normally pay a significant dividend, but a lot of the time it's with franking credits. So a lot of the time, essentially, the company pays tax on your behalf. Again, if it's within superannuation, the company will be paying 30% tax, but you only normally have to pay 15% tax. So there's an arbitrage there to say, well, why do you invest your superannuation in ASX listed stocks when you can look at other things like the S&P 500, for instance? So there is an investment asset allocation piece to look at with retirement planning as well, when you do kind of look at when you're going to start drawing your investments versus not drawing them from that side.
Yeah, definitely. I think that's why I said it's a depends question.
It is a depends question. It is. But like, if
the key message is you just got to be investing.
And again, like superannuation is great because you've got potentially monthly or quarterly, your employer puts money into this, so you're dollar cost averaging, you're getting money into the market, whether it's up or down, you're still putting money in on a regular basis, and that kind of discipline over a long period of time makes a big difference on the investments as well. So it is something, if you don't get PR, then you need to fund your retirement, that gap, through other means, then it's definitely something you should be looking at. And as a kind of broad picture, you'd be looking at 12% as a minimum. So if you think, okay, well, I'm getting paid X amount, I need to make sure that 12% of that goes towards retirement if it's not doing that.
Well, the mandatory super contribution is 12% now.
They're trying to get it to 15, but I don't know if they'll get it there. Again, if you've got the means to, again, people who are living in kind of expat land normally get paid relatively well, so why not try and front load that and go to 15-20% of what your earnings are capacity are if you've got the ability. And again, it doesn't have to be through investments. It could be put that towards a property, put it through something else. It just has to be, okay, well, this is earmarked for my retirement, and then start putting away that amount each year.
You need to have a plan for your money. That's what you need.
You do.
Probably a little bit on my side is property and mortgages, and I think I'll talk a little bit about the mortgage side of it, and then I'll lean on you for some of the tax part of it, Tristan. But the mortgage side is relatively straightforward. There's a few things to think about. So firstly, it's understanding where you're at now. So I always say we should have this conversation 12 months before you plan to go. What is my situation now? What am I using my properties for? And what do I intend to use my properties for when I go back? Are you planning to keep them as investment? Are you renting them to family? Is one of them going to become your home? because it's very, very important to understand that once you're back, you need to understand the debt allocation on each one.
Yep.
What's going to be deductible, what's not going to not be deductible. Is there a better way that we can structure things to make it easier when you go back? The second part of it is understanding with your repayments what the cash flow looks like on those mortgages when you go home too. So, you know, once you go back, you might be paying principal and interest on every loan now, and you've got a good income offshore. When you go back and you get that first payslip and you see all the tax and everything that's been taken out of it, you can start to feel like, oh, I don't have as much free money as I'm used to.
The holiday budget
to pay
gets
for
cut.
all of this. Yeah. So I think budgeting becomes a really big thing when you go home. And we quite often talk about, okay, I've got quite a few clients that have maybe 1 to 2 investment properties, and then they've got a larger property that they've purchased, which will become their home. So for a lot of them, we might look to say the investment properties, we might want to move them onto interest only before they go back, just to help them free up the cash flow, not be so stressed when they go back. They might still have some decent offset funds to use to meet those. And then for the home, we can look at, okay, when you go back, what's happening? Can we look at refinancing? We can always, so if you've got a home that is an investment property now, but you move back, we can normally quite easily switch that loan to an owner-occupied loan. When you return, it'll get the rate down by 0.2%, 0.3%. Every bank, that's always the path of least resistance. And then depending on employment situation, when you go back, we may even be able to refinance it to another lender that's cheaper too. So I always say, just keep in contact with me, and we kind of look at, okay, 12 months before when you get back, and then the 6 to 12 months after, what's happening work-wise. Do we need to restructure your borrowings? Again, the name of the game is just making everything as tax effective as possible and making sure the cash flow management's as easy as possible as well. So,
what about,
and getting the best rates.
Yeah, exactly. Get the best rates. Get the best rates. What about the strategy? Like a lot of clients that I've got going back, and they've been fortunate enough to pay off their loan or sit it in an offset account. So say, for instance, there's $2 million property, $1 million sitting in the offset account against $1 million loan. So that's netted off basically the same, but they're moving back into that property and then potentially want to buy another property in the future. So again, both of you are better at this than me, but what about like in case that rather than pulling out 200 or 400,000 from that offset account, is there a better strategy to help from a tax and in terms of potentially paying that loan off in full and then get an equity release for the investment property?
I think there's 2 parts to it. So number one, it's allocation of offset funds. So obviously, I always tell my clients, you know, a lot of them come into a fair chunk of money and they're like, I should pay off my loan. But I'm like, is this property going to be an investment property forever? Do you ever intend to live in it? I'm like, if you don't intend to ever live in it, always just utilize the offset facility. Put it against that. Preserve your debt on that property, because there's, you might need access to the equity or the liquidity in that property, right? And if it's sitting in your offset, you can access it straight away, and you've preserved all your deductibility against that property for the future. Something really important to understand, and Tristan will probably reiterate, is once you pay off the loan, you pay off the principal, it is paid off forever for tax purposes. You can't redraw, you can't retrospectively claim deductibility again. If you do any redraws or new drawings against that property, it needs to be for a new tax deductible.
ATO follow the cash, basically.
Correct. So once it's paid off, it's paid off. And if it's an investment property, you've basically, you've ruined your chances of having deductibility on it in the future. And you could have used that money to instead pay off a loan that's not tax deductible, or do improvements to your home, or fund it as a deposit for another investment purchase that you want to do. So you're really trying to hedge your bets and keep liquidity for yourself by I just tell my clients, utilize offset as much as possible. You can't lose. Once the money's in the offset account, you're not paying interest on it anymore.
Use offset for investment properties, pay it off if it's your own home, essentially.
If it does become your home in the future, it's a different story, right? And it becomes a good question for Tristan to talk to them about around. We could probably do this as another topic, is debt recycling is its whole thing.
It is. Buzzword.
Maybe I'll put that in the restructuring podcast next, because it's a big part of it too. And we do a lot of it for people that go back, have had big debts on their home, and we're trying to find a way to make it more tax effective for them.
Exactly.
As well.
Exactly. That's it. It's I'll make sure I drink lots of coffee before that, because it's I've got to make sure with debt recycling, you got to follow the bouncing ball, so to speak. But,
it's a lot of logistics.
Yeah, it's logistics, and clients that do it well have good systems in place, but you got to make sure you don't mess it up.
Yes, we do a lot. It's a lot of hand holding, and we got to transfer on this day, redraw on this day, move the money over here. We'll kind of maybe map it out for someone.
Yes, I think It's a couple.
There's a lot of little steps that are in themselves are simple, but you got to get it right to get it to work.
Yep.
So.
And what about for the mortgages side? So you're moving back 1st of October. What else do you have to do from a mortgage perspective?
On the day that you go back itself, we just need to, once you're in the property, we typically just need something to show you living in it, and then we can swap the loan to a cheaper rate. And then once you're settled, you're working again, we can look at other refinance options as well. It really just depends on everyone's
And
situation.
for the value side of things, Tristan, what will the ATO accept from a valuation perspective?
Really good question, actually. So this is the valuation piece. There's a little bit of confusion around valuations and when they actually apply for assets moving back. So you've got there's two valuation points with Australian property. So one is 8th of May 2012, which is when the 50% capital gains tax discount was removed for non-residents. So that's basically if you owned an investment property and you're living offshore at that particular point in time, you need a valuation at that point, and there's nothing dodgy about getting a retrospective valuation that could be written on today's paper, but just note at that point, and that kind of crystallizes how much of the 50% capital gains tax discount you get. The second one is if you rent the house out for more than 6 years and it was previously primary residence, the valuation point is when you first start renting it. So not when you get home. So and then it's like an apportionment game after that. You get 6 years capital gains tax free growth. After that, you continue to rent it. It's taxable, and then you move back into it. It's your home again. So it's basically big situation where you chalk it all up on a I was going to say chalk it up on a whiteboard, but that doesn't work. But write it up on a whiteboard and sort of work out the periods. But the valuations do apply earlier. I think Jamie, you're talking about it with bringing assets back into Australia. Offshore shares or even offshore property. So if you've got you're returning to Australia, got a nice little Airbnb in Bali that you're renting out, you need to go to a Balinese valuer at that point in time and get a valuation. And it's basically a market valuation by a valuer in the jurisdiction that the property is based in. So, yep.
We have a whole video on capital gains and property as well, so we might even link to it in the description for this, because it's a complicated topic, and it's the short answer is you need someone like Tristan to calculate it for you, because it's all over the place.
Different methods and different dates.
Yes, and it's important, especially if you want to sell, regardless of whether you want to sell before or whether you want to sell before you after you go back. You need to understand what the implications are, because there's one little misnomer that I hear is someone bought the property, actually doesn't matter whether they lived in it before they moved overseas or they bought it as their home while they were away. It was investment for a while. They've moved back 6-12 months later, they're like, oh, I can just sell it and it's completely tax free and I don't have to pay anything.
Sadly not.
On it. It's not the truth. So again, Tristan breaks it down in that video, but while you're offshore and it's an investment property, there will always be a period that there is some tax implication on it. So it's important to understand what that actually looks like.
And I think as well, when you're talking about timing, do that early rather than later. Because I think there could even be positions, if it's a 100% investment property and they've been offshore the whole time, to sell it offshore rather than onshore. For some people, especially if they're still working at 47 cents in the dollar. So there is calculations that Tristan can do to help, but there is other strategies. Okay, if they're going to sell it within the first 12 months of going back, then it might actually be more beneficial to sell offshore.
And what's the bigger picture? What do you need the money for? So there's a lot of things that go into it. So I just want to touch on, obviously once they're back, everyone knows once you go back you have to start paying Australian tax. You're going to get that first payslip. It's going to look very different to when you've been away, if you've been away in somewhere like Singapore, Dubai or Hong Kong. What are some of the, I can put a little bit of a positive spin on it. What are some of the things that people can do when they're home, Tristan, to help reduce their taxable income? One common thing I see is a lot of people, you need a car when you go home. Yep. So salary packaging vehicles is a very common way that people get their tax down.
Like it's a so the rule of thumb with salary packaging a car is if you're a traveling salesperson that you do in your car all the time and using a lot of chalking up's the wrong term. Can keep coming.
You love your blackboards.
Yeah, I love blackboards, exactly. I don't think there's any blackboards exist ever in the world anymore. But anyway,
I've got one at home. My little
there you
kids.
go.
There we go.
There's one.
There is some.
Is this where the vision board goes?
This is this is a little A-frame. The little one.
Love it.
Vision board's in the bathroom.
Vision board. I've lost my chain of thought now, gents. Okay, here we go. So
salary packaging.
Salary packaging. If you're traveling salesman and using a lot of genuine kilometres where you're literally going from client to client, town to town, basically selling or visiting clients or whatever, then the logbook method is the best method for claiming a car. So that's where you get a logbook, you keep it for 12 weeks and work out a percentage of claim of, percentage of tax deductible kilometres over non-taxable kilometres, and then that percentage gets applied to everything. So
something I learned, there's an app now.
Exactly.
Yes, it's not the book anymore.
It's not the book,
So,
exactly.
I just learned this recently.
I'm feeling old now. I'm talking about chalkboards
the books, the logbook.
Like there's an app for it. I was like, of course there's an app.
We're getting your license, having to fill out that logbook to get your license.
Love it, those days. But if you're largely just doing travel from home to the office, which is non-deductible, even though it's work-related, it's specifically non-deductible, then salary packaging is best. Currently, there's a deal on EV cars for how much longer we'll find out, but there's no fringe benefits tax on electric vehicles. So if you do salary sacrifice via electric vehicle, there's no fringe benefits tax. It's being clocked on there, so that's just a pure deduction off your salary, so deductible. So salary packaging, there's plenty of good websites out there that do it. And normally you just go to your employer and say, hey, who's your preferred salary sacrifice provider, and they'll tell you. So that's a good one. Other ones, other ways to reduce your taxable income. There's additional super contributions over to Jamie's side. So that sort of thing you can think about.
Which you can also salary sacrifice, or you can make lump sum additional payments.
So they have a relatively new. I think in the last 2 or 3 years, they've said that you can pay the past 5 years contributions from a tax deductibles perspective. So again, if you've got a balance of less than $500,000 in super, you can make up the last 5 years of your super contributions, which are tax deductible. So it's up to about 150, 160,000, depending on how much you can actually go back.
Because what's the typical? What's the amount you can pay additional now?
Normally 30,000 a year per annum at the moment. That's as a tax deduction. Again, the employer contributions is part of that, but if you wanted to do the salary sacrifice, the top up part, 30,000 including your contribution, employer's contribution is the maximum from that side. So if you've been offshore for 5 years, haven't made any super contributions, then you've got that full access to use that 150,000 again. You pay contributions tax, which is 15%, but you potentially don't pay 47 cents. So there's that 32 cents in the dollar arbitrage from that side of things. So it is a good strategy for the first year back potentially.
Especially if you're selling any property or any assets that have capital gains bills in that first year as well. It's a good way to offset some of that too.
Exactly. They'll bring forward lump sums. What I think another thing we touched on, maybe you again touched on this, Jamie, was drawing money out of your mortgage. I guess you're both talking about drawing money out of the mortgage and using that for a tax deductible purpose. So buying a portfolio of shares, it might be fully franked, Aussie ASX, whatever, 200 shares, paying your fully franked dividends, or buying another investment property, which is obviously the major come talk to you, and and if you're buying it more for the tax play, you'd buy a brand new property. So you get the maximum depreciation, the interest is tax deductible, and that'll produce a nice loss for you. It'll reduce your taxable income going forward. And also something else to think about, if you are going back and you're carrying lots of tax losses, in that first year you can always apply for a pay-as-you-go withholding variation. So to actually get more of your salary back before you actually get your refund.
So that means your monthly, fortnightly, weekly pay you apply for this, they'll actually adjust how much PAYG tax you pay each month, which will be a lot less.
Exactly.
On the amount of losses that you've had.
Yeah,
right?
exactly. Yeah,
So you get to keep more in your pocket.
Exactly. Yeah, exactly. More in your pocket rather than wait for the refund.
Yeah.
Yes.
Sense. On the when you go back, Tim, how long is it until people can refinance? Say, for instance, they go back to Australia with a new job, for instance. How is it? Is it 3 months, 6 months? How long do you have to wait to get kind of serviceability requirements?
It just depends on what's happening employment-wise. So say, say, I don't know, 1 person, 2 person are working, and you're either both moving back with your employer, or the 1 person is. If it's with the same employer, we can do it straight away. And quite often I can even do it based on the new package or the new contract they're going to get when they're in Australia. We might just need the first payslip to confirm they've moved and they're actually there now. If you go back, employment's uncertain, or you're going back and you have a new employer, it really depends on the lender. But if you're going from one job to another and it's a similar industry, again, quite often we can just use 1 payslip and the new contract with most lenders. And as long as there's a story about what's happening, there are some that need 3 months though. Okay. So it really just depends on, I guess, the work that people are doing as well. But you don't need to wait. You don't need to wait 6 months. We'd only have to wait 6 months if it took you a while to find a job before you go back. Okay. So once you've got the job, typically 1 month is all we need.
Fantastic.
Yeah. Some little small things that end up being big things, because I'm in a lot of expat Facebook groups and all I hear is things about Medicare cards and health insurance and life and income protection policies. When's a good time to do all of these things? Are either of you experts in Medicare? I don't know that much.
Not really Medicare. I can talk about the other ones.
Private health insurance?
Yeah. Okay. Well, I think Medicare from a residency point of view, then you could probably talk about this, but if you're using Medicare when you're offshore and you're only offshore for a couple of years...
I still have my Medicare card.
That can...
and I still use it every time I go back.
I think you should hold on to it. Yeah. But I think if you're using it, it can pull you more towards Australian resident for tax purposes quicker than you need to.
Yeah, it's one of the many things that stacks up. I think the official rule is you can use it for 5 years after your basically 5 years after you change residency.
Yeah, so, I've still got it after 10 years. So
I think having it's one thing because you need it for IDs sometimes, right?
And they're just a pain to get again, like I said.
I'll talk about like the life insurance side of things. Because I think that's important as well.
Much about private health insurance? You have to. I don't know the rules actually. Do you know?
A little bit, yeah.
The tax side of it, right?
So the private health insurance, with that basically. When you take it out, they'll load you up. Jump in, Jamie, as well, if because Jamie's.
Maybe I'll ask the question. We'll get it on camera.
Okay.
I think focusing on private health insurance first. What are some of the things people need to be aware of, kind of a little bit from a tax and I guess a process?
Yeah, so I think in terms of that, most people in Singapore would have international cover. Again, international cover doesn't mean you're covered for other things in Australia, as long as, especially if you're going to become a permanent resident in Australia and live there for, that's going to be your home going forward. So you will have to get other insurance in Australia or new insurance in Australia. The big benefit you do get when you get private health insurance is you don't necessarily have to pay the Medicare levy, which is 2% on top of what you're earning. So that's where there's a trade-off between kind of, yes, the premiums can be big and large, especially with families, but you're trading off not paying that extra 2% Medicare levy that you'll potentially have to pay as well.
Correct, yeah. It has to be, I've got a couple of clients that we were running this argument to ground recently, but it has to be an Australian-based policy.
Yeah.
And there is a list as well. Yeah. So a lot of people are like, I've got Bupa in Singapore, and sadly, even though there's a Bupa in Australia, they kind of, from what I understand, they operate as two different businesses, and
completely different entities. From the ATO's eyes, it's it's different from that side.
If you've had coverage while you're away, is there, and obviously you haven't had coverage in Australia, but is there a way that you can avoid the cover loading by showing
bonus and things like that?
Yeah,
it's an argument. It's if they're feeling nice from that side. Because you get the loyalty, you get the no claim bonus. bonus. And then also there's waiting periods as well. So
Yes.
it could be a significant period, like 12 months potentially, that you've got to do a waiting period for some new policies. So if you have to write to them to get them waived. Again, especially if you're going from a booper to a booper, they're normally okay about it.
Okay.
But there could be some coverage you've got in Singapore that don't have entities in Australia. So you're probably going to be looking at that, the no discount from a loyalty perspective, and then also the waiting periods as well for some parts. You will have to do like health screenings again, most probably. So it can be difficult. I remember trying to hold on to my private health insurance when I was here, but paying those premiums for about 3 or 4 years, I'm like, it's just wasn't worth it in the grand scheme of things. But it's something you just have to look at from that side. And again, families who have had children offshore, my kids, they're 3 and 5, they don't have Medicare cards. So making sure you get those Medicare cards and get them into the system as soon as they get back there is something that you
Which
have
can
to
take
do.
a little bit of time.
Yeah,
as well.
it can take some time from that side. And the last one, kind of looking at like life TPD, income protection insurance.
Yes.
We touched on earlier superannuation, and when you leave Australia, because a new law came in about 4 or 5 years ago, if you're not contributing to your super for I think 2 years, they will potentially cancel your life cover or TPD cover. So you just got to make sure that you keep that running, and you have to opt in for it. So it's not like an opt out; you have to opt in for it, because what they don't want is you have 3 or 4 different superannuations. Each of those have got life and TPD cover, and then you're paying for premiums that are doubled up potentially, and your superannuation balance is getting depleted. So the government changed those laws where you have to opt in if you're not contributing for a long period of time. So again, it is kind of reviewing your insurances before you go back to Australia. Singapore's a cheap place to do life insurance and TPD insurance compared to Australia, just because it is competitive here, and most of the time you get international cover from that. So you can, different to health insurance with life and TPD, if you get it here, you can transport that back to Australia, and is flexible from that side of things.
Yeah, and Jamie, talk us through a lot of questions I get from people is, they say I've got life insurance in my super, will that cover me? And I know there's a difference between the policies in your superannuation versus the policies you might get up here in Singapore or.
The main difference between Australia and Singapore from a policy point of view and definitions is the definitions in Singapore are the same regardless of the provider. So they're actually definitions are from the Life Insurance Association of Singapore, LIA Singapore, where they've got their own TPD definitions. There's 72 of them. If you trigger one of those, then you're going to get a payout. In Australia, it's up to the provider. So the provider's got different terms and conditions based on each condition. So it depends on the provider. If you've got life and TPD within superannuation, you could get a payout into super, especially for the TPD side, but it has to meet under the SISAC, superannuation income stream, I think. But then essentially the SIS Act has to allow you to take those benefits out, so it can become trapped within super. Obviously, if it's a life payout, then that will be paid out pretty quickly. But with the TPD, you just have to make sure it would meet the SIS Act from that side to be paid out.
Just gets complicated, right? Then, because if you had a payout in super, then you'd have to apply to, if you needed the money, apply to get your super out early for extenuating circumstances. And it's just a lot more painful.
You can get income protection within
yeah.
super as well, which becomes a little bit even more problematic because
when you need the money.
If you're pre 60 or 65, it may be difficult to get the money out from that side. But there's again, when you do go back to Australia, the income protection you get in Australia is tax deductible against your.
That was going to be my next question, actually. It is. It's like the premiums are tax deductible. For that, and then similarly with your life and TPD, they're tax deductible within your superannuation for those premiums as well. So you can fund part outside your super, you can fund part inside your super, and there's different strategies around which ones you should do for those ones. Yes.
With your super, the policies used to be very broad and kind of more like group insurance, where now you can get like personalised protection within your super, which makes it much more appealing for people as well.
Definitely. Last kind of general topic, moving money and getting assets and money and cash back home. When to do it, what's the best way to do it? I get a lot of these questions as well. I think the God, what
I
would
think the
say?
biggest fear for people is like they send cash back to Australia. Am I going to get taxed on it?
Yes,
well,
that is
that's
the
like-
first.
exactly.
Am I going to get taxed on this?
And how much gets picked up as well? Like,
Yeah.
Should I send it back in $9,000 increments? And just to dispel that myth, there's no official word on how much AusTrack picks you up on sending money back to Australia. There's no tax on capital transfers, so. And you think about the amount of money that people send back to Australia on a daily basis, especially to settle properties and to set up investments and all sorts of stuff. There's money flying around everywhere. So
I think the general rule is if you have a large lump sum, important things to know. If you've already paid tax, say you got that money from a bonus, right? Or you got it from the sale of an asset, and you paid tax on it at the time of obtaining that money. So you paid income tax on the bonus, or you paid some kind of capital gains tax on the gain, they won't re-tax you.
No.
Again, do you know what I mean? You've already paid the tax on it, regardless of whether you paid the tax onshore or offshore. As long as what they're looking for, if you're worried about your money getting taxed, it's typically money from, I don't know, ill-gotten gains or money you shouldn't
foreign
have
trust
that you've been trying to hide
that
from.
sort of thing,
From authorities, then yes, as long as the worst case would be they would send you a please explain where this money came from and what are you declaring it for, and as long as you declare it was income earned from general earnings or income from the sale of something, and I've already declared it here, you're never gonna get in trouble.
Correct. Exactly. You just show them your Hong Kong or your Singapore notice of assessment, and it's generally end of story then.
Yeah. Correct. Yeah. I think also just around like timing of transfers and FX and all those kinds of things as well. There's a whole bunch of FX providers out there. We all have relationships with a couple. So if you want advice or recommendations, my takeaway is definitely do the FX conversions when you're away offshore. So before you send it to Australia, because Australian banks are notorious for terrible conversion rates on FX. I can tell you, having worked at one, it's not competitive. You're much better to convert the money before you send it back to Australia.
Yeah.
So,
and there's specific companies that specialize this, and I think the big thing is if they're getting volumes that are sending back through their clients, then the spreads are a lot less from that side. And even if it's saying they're not charging you any fees for the transfer, it's what's the actual rate, because that's where they get their fees, because they might not charge you $20, but the spread might be 3% or 4%, so that's where it's good. And I always say there's kind of no loyalty in FX in a sense. Again, a lot of relationship managers out there won't like that, but there isn't. Like, and I do it myself. I look at like 3 different FX providers and say one time this company's better, that next time that company's better. And for me, it's just like what's going to give me the best rate at that point in time. And it's just trying to go from A to B as quick as possible. Obviously, if there's a need to get there something quickly, then you make sure that you've got a provider that can do it within 24 hours. And that you might
they're established, reliable, safe.
Yeah, exactly. Yeah. So there's the timing part, but then there's also the rates part to kind of consider as well from that side. For sure.
And I think the question of when to transfer you'd really just got to look at what's happening with FX at the time. And then, if you have a lot of lead time and you want to hedge your bets on the rate, then you can always just average it over a few months. If you know the rates. I mean, the Aussie dollar is pretty weak at the moment. It's not a bad time to be converting to Aussie. Now, who knows when this will air, but at the time.
Well, that's the hardest thing. Like, if I look back 20 years or 10 years that I've been in Singapore, I came here was the other way around. It's now about 120 in favour of Singapore dollars. When I came, it was 120 in favour of Aussie dollars. Again, now's a good time from our perspective, but again, in 5 years' time, it might be 130 in Singapore dollars, so you don't necessarily know. But again, I just say take the wins when you've got them. Again, you don't know what that's going to look like in the future. You might not have the money there in the future to trade it. So.
No, exactly.
And it's also an opportunity cost, right? Could that money that's sitting in Sing dollars or USD or something like that be doing more for you in Australia than sitting in a bank account here? So it's that opportunity cost piece as well to think about.
It's a very, FX is always a tricky game.
Very tricky
to play. Unless you're really in the know and like trading regularly on the day, it's very hard.
Well, even the FX traders that I know, they get it wrong, right? There's teams behind it, but again, not all the time. But it is a difficult one.
I think maybe to kind of summarize a lot of what we talked about, because we've covered a lot of ground today. might break it down into like different, what people should be doing at different times. So we talked about 12 to 18 months. I think the first thing is, number one, be speaking to a tax advisor.
Yes.
And speaking to a financial advisor to start looking at what is your asset base, what is your financial position, what are the things I need to be aware of and I need to be thinking about before I go back. And if so, we have plenty of time to move things around, rejig the structures, like just making yourself get ready.
Yeah, and part of it is an education piece as well, because you speak to people and they don't necessarily know about the Singapore tax exits, what it will look like when they get back to Australia. And again, we can work through those numbers to help them make an educated decision on it, whether it's like selling a property before you go back, after you go back.
Yes.
It is kind of just having
if
that
we need
back
to do any
and forth.
refinancing as well, it's a good time for us to do it.
Yeah,
too.
exactly.
So.
Not a week before, even up for your example at the airport. Now's the time to name and shame.
You can take care of it, Tristan.
I've had more than one phone call from the airport. I'll tell you that. I always roll my eyes when they happen. I was like, it's not much you can do now, but anyway, let's talk about it. Yeah.
I'll give you a call at the airport just to say hi.
By the way, I think 6 months out, it's just planning your cash flow, planning your investment transfers. If you need to start looking at insurances for when you go back, it's a good time to do it.
Yeah.
And then once you are back, I know I asked this before, but in terms of declaring when you're a resident, Tristan, there's not actually anything someone needs to officially do or write to the ATO. It's just you go in, you write your arrival card, and then when you do your tax returns, eventually this is your declared date.
Yeah, correct. Yeah, like it's the tax return is the actual main document when you change your residency on. So and you might be lodging it 6, 12, 18 months later. But the ATO, they look at all the facts at the time. So the fact that when you your shipping container went back, when you gave up your residence in Singapore and started living in a hotel, that's getting really technical. It doesn't hardly gets looked at, but when you're,
they'd have to have concerns.
If they're looking at that, like we're talking a couple of days in that situation, but when you send your pets back, that's a big one. That's because it's serious when you you send the cat or the dog back. It's generally all those pieces when the kids go back, when they're enrolling in school, applying for Medicare cards, as we spoke about before, buying cars, that sort of thing. So, and that's even in those situations where you've got, husband and wife go back, but let's say husband needs to stay in Singapore for a bit longer to wrap up a bonus or finish up business. If you are in Australia getting set up, you wouldn't bother getting the husband's Medicare card set up yet because he's still living in Singapore. You wouldn't buy a car in his name. You buy a car in the wife's name. All these kind of things. So the person who's still living in Singapore, keep them a very low profile in Australia because they're living in Singapore up until the time they're not. They're all the things to think about.
Yeah. Important to get advice again, just to make sure you have a plan. Right. Exactly. If you don't have a plan and then they start coming to ask questions later on, that's when it can just get very stressful for everyone.
Exactly.
Yeah. So, and like from the investment side, I think making sure the cash flow is there, because moving is expensive. Again, you've got potential taxes that you don't have assets for that you can't sell, and it is a stressful time. So you want to make sure you've got a decent cash buffer going into moving back home. Obviously, buying a new car might be expensive. Transport costs, shipping, not shipping, but sending a pet back. It's probably going to cost you more airfares than yourself.
Yes, an emotional turmoil. So.
Yeah, exactly. Yeah, and I don't want it. I call it the 2 a.m. bucket as well. It's just like if you wake up at 2 a.m. and you're struggling to have a cash balance, then I'm not doing my job properly. But it's just one of the things you've got enough worries at that point in time, so you don't need to have that 100%. As well. Yeah.
I think from my perspective, once you get back, just talk to us. We can see if we can get the loan a bit cheaper, and if possible, a few months later, even refinance to something better as well. We have the whole world of banks when we go back to Australia, so it's not as limited as when you're living offshore. Thanks, guys.
Very nice.
I think we've covered a lot of ground today. There's a lot of really helpful information in there. I think for any of our listeners, if you have any other questions, anything else that you want advice on, or anything else you want us to cover, then by all means, please write in to us or book a session in with any one of us to have a chat. And like and subscribe to all of our links on Spotify, YouTube, and any other good places that podcasts are listed. Thanks again.
Thank you.
Cool. Thank you.